One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights. This is the only show dedicated to helping you learn both the technical and non-technical aspects of the investment banking process. Hello, my name is Alex Mason, and I am your host. I'm so grateful to be with you. I am a first year, rising second year Cornell MBA student and going into investment banking this summer. Super excited. But today I want to talk to you about depreciation, applying this concept of depreciation to an actual problem that we can solve, and that is kind of a basic accounting type of question that you might encounter in an interview. And the question is this: walk me through $10 of depreciation on the financial statements. So let's go ahead and go to the whiteboard right now and actually work this out, and I'll talk through my thought process as I solve the problem so that you can understand it. Okay, so when we're setting up this problem, let's first put the three financial statements on the whiteboard. So we have our income statement, we have our cash flow statement, and we have our balance sheets. Now, on the income statement, depreciation is going to be reflected, but it's not going to be reflected explicitly. That's kind of one of the weird things about depreciation in the income statement is the cost of depreciation, the cost of an asset losing value over time. It's usually not explicitly stated as a line item, but it is a very real expense. It's just not a cash expense. So that's one thing that you should understand first and foremost. So when we're thinking about the income statement, remember that we have revenue at the top, we have our cost of goods sold, our COGS, and then we have other operating expenses. And then if we subtract those out, we get something called our operating profit. So operating profit, also known as EBIT, or earnings before interest and taxes. So we have $10 of depreciation. The first thing that's going to happen is our operating profit is going to go down by $10. Because remember, depreciation is hidden somewhere in here. Somewhere in these COGS or operating expenses is your depreciation. So your operating profit is going to go down by $10. So let's continue walking through the income statement to see what happens next. So if our operating profit is down, remember on the income statement, once you get to operating profit, you have to continue to work your way down through other types of expenses before you get to net income or your final profit number. So what are those other expenses? Well, for the sake of this example, we're going to assume there's no interest expense, but we are going to assume that there are taxes. So let's go ahead and assume a 30% tax rate. And with a 30% tax rate, we're going to have $3 in taxes. That's 30% times 10. And so our net income is going to go down by $7. So that's the first part of answering this question, is walking your way through the income statement and understanding how depreciation flows through each of these items to ultimately impact your net income or your profit. Now, another thing that happens, this is a key connection that I didn't mention in a prior episode, but your net income connects to the top of your cash flow statement. So net income goes to the top of your cash flow statement. And we know that this is down by $7. Another key thing related to the cash flow statement when it comes to your non-cash expenses, whatever happens on the income statement that's not a cash expense, you have to then adjust for it on the cash flow statement. So because this $10 of depreciation, the company isn't actually paying those $10 out anywhere, it just happens. It's just a real expense due to the value of their asset declining over time. So in the sense of the cash flow statement, we're actually going to add this back. So we're going to add back the $10. And so if we add depreciation of $10, this is going up, that means our net change in operating cash flow is positive $3. So because the company is taking a non-cash charge, yes, their expenses are going up, and yeah, their net profit is going down in an accounting sense, but from a cash perspective, they're actually making a little bit more money in terms of cash. Because guess what? You have this tax benefit that effectively is put into the effects of depreciation. And so you get that benefit over here on the cash flow statement where you have this $3 going up. So your cash flow statement is going to go up by $3. So there are no other changes here to the cash flow statement. Now let's connect the cash flow statement to the balance sheet. Remember that cash is an asset, and assets go on the balance sheet. So since our $3 is going up over here, this connects to our asset side of the balance sheet. And so our cash goes up by $3. And what about on the liability and the equity side of the balance sheet? So our cash has gone up by $3 at this point. Now, what else is happening? Remember that depreciation is a cost against an existing asset. So let's say that this depreciation is affecting some kind of factory or some other kind of property, plant, and equipment that the business owns. So the value of that asset is now $10 lower because of the depreciation expense. So on the asset side of the balance sheet, we take depreciation and that goes down by $10 just by definition of the problem that we're trying to solve here. So cash is going up, depreciation is going down, and so the asset side of your balance sheet is down by $7. Now remember, we have to make sure the balance sheet balances. Remember, assets equals liabilities plus equity. Fundamental equation of accounting, right? So on the liability side, nothing's really changing here. The company didn't borrow money, they didn't pay off any debt or anything like that. So we can just skip that part and then move on down to the equity portion of the balance sheet. So how do we account for this? Well, remember, all the way over here on the income statement, if there are changes to the net income of a business, that flows over to something called retained earnings, which is a component of equity. So because the company in this case is down by $7 in net income, that's going to reduce the equity of the business also by $7. So there's a connection here. And so retained earnings is down by $7. Now the $7 matches the $7 here. Notice here your assets went down, your liabilities didn't change at all, and your equity went down by the same amount. So the equation is in balance. And that is how $10 of depreciation expense flows through the three financial statements. So it might seem very complex to you if this is your first time doing anything like this, but if you can master this problem, you can understand a lot of the key elements that go into many other accounting type of problems you'll see in an investment banking interview. Okay, and that's what I got for you today. Thanks so much for watching or listening to Investment Banking Insights. I'm Alex Mason, your host. I'll see you on the next one. Bye.